Ben, we're going to give it a little countdown. You ready to go?
Yep, perfect.
All right. 3, 2, 1, let's jam. Hello and welcome, everyone. I'm Corey Hoffstein, and this is Flirting with Models, the podcast that pulls back the curtain to discover the human factor behind the quantitative strategy.
Corey Hoffstein is the co-founder and chief investment officer of Newfound Research. Due to industry regulations, he will not discuss any of Newfound Research's funds on this podcast. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of Newfound Research. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Newfound Research may maintain positions in securities discussed in this podcast. For more information, visit thinknewfound.com.
In this episode, I chat with Ben McMillan, a founding partner of IDX Insights, a firm offering custom indexing as a service. Ben cut his teeth in manager analysis at a fund-of-hedge-funds, and we spend a considerable amount of time discussing how this experience impacted his research in building hedge fund replication strategies. As it turns out, a naive replication strategy is very easy to implement. A robust one, however, is deceptively difficult. One of the most interesting insights I gleaned from this conversation is that the edge in replication may not be in applying more sophisticated math, but rather in the data sets applied. We discuss where replication might work, where it doesn't, and the dependent nature these liquid replicators have in crowdsourcing their allocations from their less than liquid peers. Finally, we discuss how these sorts of replicators might be further enhanced by replacing standard beta factors with more customized index solutions. Ben is full of insights, and this one runs long, so let's not waste any more time and let's dive in. Ben, thank you for joining me today.
Thank you for having me. This is great.
So let's start with a statement that I think is going to set the table for the whole podcast, because you've had quite a career trajectory and arc. There's a lot of stuff I'm really excited to talk about, but there's really one focus point of this podcast that I'm really excited to dive into. So I want to set the table with a statement, which is you believe that many hedge fund strategies can be meaningfully and accurately replicated at the category level using highly liquid instruments like ETFs. And I just want to let that marinate for a second, because it's somewhat of a controversial statement. There's all sorts of replicator products out there that we're going to talk about, but I think maybe those folks in the hedge fund community might take a little offense to that. So I think this is going to be a fun one, and we're definitely going to dive into that topic. But let's start the story, start the narrative, picking up your career in the mid-2000s. If I am correct, you were at that time working at a fund-of-hedge-funds, and this is really where you cut your teeth doing manager due diligence and return analysis, and maybe, reflecting on that initial statement we made there might have been a pretty formative experience for you. So can you tell me a little bit about that experience, maybe some of the things you learned while you were analyzing manager performance, and maybe some of the things that surprised you?
Yeah, no, absolutely. And I'll even back up and tell you that I can guarantee a lot of people in the hedge fund community will take issue with that statement because I've lived it real time. But so I joined an asset manager called Lister Watson in January 1 of 2008, just as things were getting interesting. And they had a couple of different components to the business, which was appealing to me. They had a third-party marketing arm, which had been around raising money for hedge funds since the mid-90s. They had a fund-of-funds group, which had, I think, 3 different fund-of-funds, about $2 billion in assets. So they weren't huge by any stretch, but they were big enough, coupled with the fact that they had this kind of third-party marketing arm that was early in the game, raising money for hedge funds. They had a lot of access to marquee managers. So I was coming out of American Express, actually, where I was working in the quantitative risk underwriting department. So the guy that hired me was a quant. He had a lot of kind of skunkworks type projects in the mix, over and above kind of the traditional manager due diligence, attribution analysis. And so he wanted, he was looking for a certain skill set to bring on board and work under him. So he hired me, started, like I said, beginning of 2008, which was the perfect time. And the first thing he had was he was a big data guy. So, and I don't mean big data, and that term wasn't around back then. So big in the sense that he appreciated having his own database of managers, scores. He actually developed his own kind of manager ranking score that ultimately he ended up getting patented. And this was all in Access, like Access 2001 database. So the first job he had was like, just figure this out. So I moved it all to SQL, automated a bunch of stuff. We had kind of nice reporting sitting on top of it. Because of that, I was going to all the manager meetings, all the cap intro events. They had 2 full-time guys doing manager due diligence reports, but I went on every single one of those meetings. So it was phenomenal because it was just a ton of data points at a very interesting time. Interestingly, having been at Amex actually in 2007, that was when the bear funds were blowing up, and I can say it now, but we were sitting there. American Express was unique because they owned their POS network, which meant they had a lot of data, proprietary data that the other credit card companies didn't have. And so we were seeing things like revolve rates skyrocket, even among the prime customers. And so there was a lot of, by the time I came over, there was a lot of chatter, a lot of writing on the wall that things might be going south. Like I said, particularly after the bear funds blew up in 2007. So obviously 2008 happened. Well, let me back up. One of the things that immediately struck me, even before Q4 2008, was I was kind of expecting, this was my first job on Wall Street, and I was really anxious to kind of pull back the curtain and understand, like, all right, what's the secret? Like, I'm in the club now, guys. Tell me where the alpha comes from. And it was just a lot of the same story. Every strategy was different, but the long short equity guys were kind of all telling the same story. Bottoms up stock pickers. They spent 2 years at a bank for covering this sector. They look at it a different way than everybody else, which is what everybody else says. The distressed guys all had the same story: stat arb, convert bond arb. It was difficult from that to kind of segregate who really had kind of a persistent alpha generating process. And even kind of powwowing with the other analysts and sitting in the investment committee meetings, I was observing real time the decision making process. And it was just, there was a lot of kind of homogeneity within the hedge fund strategies, or so it appeared to me. And so Q4 2008 happens, coming out of that, and not surprisingly, or perhaps surprisingly, hedge funds didn't really perform that well. Certainly long short equity funds, they were, depending on what index you look at, our funds were down between 20 and 30%, for presumably when they should have been adding a lot of value. The other kind of part of that too is, coming out of 2008, we started seeing all these gating provisions thrown up. Managers, it makes sense. I get it in illiquid credit and distressed asset classes, but if you're trading publicly traded equities, you may not like the bid that you're getting on those stocks, but they're liquid. You can sell them. I remember one manager, even in the credit space, said that. He's like, people are saying there's no bids for things out there. He's like, oh, there's bids. He's like, you may not like what the bid is, but it's somebody's on the other end picking up that phone. And so, we were coming out of kind of 2008, 2009, like a lot of other fund-of-funds, with kind of this existential crisis between, investors were really becoming sensitive to fees, starting to question the hedge fund value prop, the transparency, the liquidity. Again, this is public at this point, so I can say it, but one of the fund-of-funds was invested in Harbinger. And I remember we were sitting on Lister Watson was, I believe, one of the funds on the creditor committee that after Phil Falcone borrowed $100 million from the fund to pay his personal taxes, that was just kind of like one of the final straws where we were talking to a lot of other institutional investors. I remember as a cap intro talking to a guy from a very big pension fund. And he was just like in complete disbelief that this, and he's like, yes, I understand it was in the docs. Like he didn't do anything illegal, but, that just kind of brought to the forefront what up until that point had kind of been an academic idea of the call option for the hedge fund manager. The idea where if he loses money, he doesn't really have any skin in the game. He still clips his 2% management fee, but he's at certain points they're incented to take, perhaps asymmetric or uncompensated risks because it's a call option. And so anyway, like first half of 2009, this is all kind of rising to the top. A lot of fund-of-funds, like I said, are questioning their own value prop. There was even I remember being at a conference talking about, and somebody's, questioning the value proposition of funds of fund-of-funds, kind of the fund-of-funds cube type model. I just remember going back, like we were talking about, it was like almost a Dilbert strip. We were sitting there around the investment committee back at the office. Like at some point, this is getting ridiculous. Like people are going to say enough is enough. And so meanwhile, we had the guy that hired me, Mark Fried, and I had already been doing a lot of work on the attribution side, really understanding, is this hedge fund, aside from what their process is, what the qualitative write-up says, are they adding value relative to their peer group? If so, how much? How do they do it? And one of the things that followed on from that was this idea of not just running factor attribution against ethereal factors, but really starting to put constraints on what those factors were and specifically look at things that we could trade. The asset manager had a broker-dealer, and so this was something we started really considering, was the idea of, all right, if there's a lot of beta, and that was one of the things. So let me circle back to the very beginning when I was talking about, a lot of the stories seem the same. Well, fast forward, by the end of 2009, early 2010, we did a real deep dive. My full-time job at that point became, really trying to dig into the idea of, statistically replicating some of these risk return streams. And what we found was that there's just a lot of systematic risk in these different hedge fund strategies. So hedge funds as an asset class, maybe not so much for obvious reasons. Long short equity funds are doing, employing very different strategies, harvesting very different, risk premium than credit funds or stat arb or things like that. But if you segment the strategies well, and I'll come back to that because that wasn't necessarily a trivial process, but we had our own database. If you really create these kind of homogenous groups of hedge fund strategies, you find that, there's a lot of the same underlying risks driving all the funds in that strategy. And this was about the time that, like I said, the idea of hedge fund replication was really coming to the fore out of academia into kind of products on Wall Street.
So I'm going to go ahead and break my cardinal rule of podcasting here and just take a complete tangent after my first question. I may pull off the highway of my main thread here, but there's a lot of discussion that I've been having both online and offline with folks about the applicability of a lot of the factor models and risk models that are available today. And you see it very frequently now. It's a value proposition of a lot of asset managers to come in to an institution or an advisor and run some sort of factor, risk decomposition, throw back a 30-page PDF and talk to them about what their exposure is. And my frustration with that has been the results are perhaps directionally correct, but never truly very precise. That depending on how you run your analysis, the time series you use, the factor definitions you use, you can get very, very meaningfully different results. And so in your experience in running all this analysis and attribution, how useful did you find it? Where was the use in running that analysis? Was it in the actual precision of identifying the factor exposure one manager has versus another? Or was it just categorically being able to say, this is a value manager, this is a momentum manager?
That's an excellent point. And I could, if you just pulled off kind of the freeway of the main line, I'm just going to step on the gas because this was and it continues to be a huge source of irritation for me. And I'll start with the story. Fast forwarding a little bit, we ended up at Bannek Global, and we'll talk about how we got there several years later. And I remember coming in there, and they had an external manager 40 Act product, so a fund of external managers as a mutual fund. And they kind of gave me this 30-page PDF and said, yeah, we had a group come in and do factor attribution on these different funds. And this long short equity guy's, all upset because he said it's just, totally fake. And so I was like, all right, well, let me see what the attribution says. They were kind of like, you're the guy with a degree in econometrics, like you tell us what's going on. And so the first thing I looked at is like, there was no leverage constraint. So it had this guy running it like, they were running linear regressions, but they were inferring like 2 or 3 times leverage. The Swiss franc was in there as a factor. It was all over the place. And it was like, I was like, I don't even care. They're like, yeah, but the T statistic, I was like, I don't even care what the T stats, what the T statistic says. I was like, you've got to put some sensibility constraints or filters in place if, before you even run this. Otherwise, the regression isn't a genius. It's not going to figure out and intuit these things. You've got to put guardrails in place. And so back to kind of your earlier point, we were very, and like I said, this was originally my formal training, and this is, at American Express, we were running regressions for a living on huge data sets, and they were very focused on robustness, and they would just drill into you that you can't just hit F9 on a MATLAB code and look at the correlation coefficients and take it as gospel. You've really got to make sure it's fundamentally robust in the way that you set up the apparatus for in this case, regression to make any inferences. And so what we found at Lister Watson is we almost never ran individual managers against factors, or if we did, we would include the peer group as an explanatory variable. So we would look at, long short equity fund A, run a regression against our index of long short equity funds, and then we would include a handful of other sensitivities to understand to what degree on a risk-adjusted basis where they may be tilting more towards value or more towards growth or more towards a particular sector relative to the index. But that was crucial, was including the kind of anchor explanatory variable of the other long short funds, because then you're just instilling a higher likelihood of robustness around the other factor sensitivities. But just taking an individual fund and running a regression against, that's the other thing too, against a lot of factors. There's this tendency, and this is, I don't want to go into a huge segue here, but this is one of the things separately I've kind of observed, and you will have too, a lot of quants have in the last 10 years is computing power has gotten a lot cheaper. All these analytics packages are free or very inexpensive now. R and Python, the Pandas library, replicates what my $250,000 SaaS ETS package at American Express did 15 years ago. And so that enables a certain laziness. It's easy to just kind of hit F9 and see what the computer spits out. And if it can be appealing if you don't know the landmines to look for. So I 100% agree, and you absolutely hit on what I think continues to be one of the biggest issues in Wall Street in particular is just the cheap data, cheap computing power has kind of led to this lackadaisical quantitative approach. And so just to wrap that comment up, yeah, as it relates to kind of factor replication, our dependent variable, the thing we were replicating was never an individual fund. And there were some products out there that attempted to do that, or they would take 3 or 4 funds. We spend a lot of time refining that dependent variable. So we would subscribe to the raw databases, manually classify, in this case, let's use long short equity funds as an example. We would look at their classifications. We would run a statistical analysis. Did they look like other long short equity managers? Interestingly, what we found, and like I said, when I joined, Mark Fried had been doing this for 10 years already. And so there was already a lot of data to kind of go back and look at things like style drift, manager drift, just misclassification. A fund can be misclassified yet show no style drift, or a fund can be properly classified and show style drift. And what we found, and again, I'm going to cite statistics from the long short equity space, was that 20% of the funds that were classified as long short equity, we would reclassify, and 5% were just incorrect. It was a fat finger error. It was long short credit somehow popped up in long short equity, but 15% were just too different from the group. And by that I mean there was a lot of like long short biotech is going to have a very different return premia, or very different drivers of return than kind of your general green light capitals of the world, kind of general longer biased long short managers. And so that was a large part of we spent as much time really refining the dependent variable that we were going to drop into the regression as we did actually kind of developing the regression methodology, because we didn't want to go down the path of just throwing more complex math at the problem. And again, there were products that were looking at, Kalman filters and, starting to integrate support vector machines. I mean, it was easy then, it's become even easier now to just throw a lot more kind of computing complexity and power at the problem. We wanted to, really make sure that we were developing a robust infrastructure such that a relatively simple linear regression could yield useful results. And that was because, I'll wrap up by saying, and that was because, we went into this exercise in, 2009, expecting to put monies in this strategy. No, you absolutely hit on a hugely important point.
Well, I appreciate you getting us back on the highway there of the main thread. And that's, it's a really interesting topic that you bring up. This is your edge in your computational power, or is your edge in your data? And to your point, in the era post 2008, the number of free open source computational tools the ability to quickly churn through that data has really gone exponential. I mean, in the Python landscape, you mentioned pandas, but things like scikit-learn and TensorFlow and all this stuff all of a sudden make machine learning techniques one line of code and makes it that much easier to just sort of throw a handful of variables in a blender and hope something good comes out. So that's something we definitely want to return to. But back to sort of the main thread about replication and a little bit of the history here, because I do find it interesting. It was in 2008 that Andrew Lo first published sort of the seminal work, I guess you could call it, on hedge fund replication. And if memory serves me correctly, it was a pretty simplistic model. It was, I think, just using 36 months of prior returns and doing a very simple linear regression with some liquid factors. He showed you could get some pretty meaningful replication. And the idea caught on pretty quickly. You mentioned a little bit in your first answer the zeitgeist of the 2008 era, but you saw this idea really took hold. I know that some banks started issuing products privately that were actual implementations of Andrew's idea. Can you tell us a little bit more about, from your perspective, working at the fund-of-hedge-funds, what things were like in the evaluation of the hedge fund community, what the attitude was towards hedge funds, and maybe why these replicators were becoming to be so attractive to investors?
Yeah. What was interesting was what I saw anyway was the reasons I mentioned previously, post '08, funds, the value prop of hedge funds in general, but I'm really going to focus on long short equity funds, started to be questioned. And really like things like the liquidity, that was a recurring refrain I heard from other institutional investors was, why does it take me 4 quarters to get out of this, long short equity fund when they're trading publicly traded equities? And so the other side of that too, and where I really started to see it kick off, was Madoff. And so I'll never forget, this is, I'm not going to say funny, but this is a really interesting story. Mark Freed was sitting at the Bloomberg one day and he called into one of the other partners' offices and he's like, hey, they finally caught Bernie. And I'm like, who's Bernie? And he's like, oh, it's this guy that, nobody really knew what was going on, but the rumor was that he was front running his clients. He came in here, one of his feeder funds came in here and, pitched us. And he's like, it's interesting. Bloomberg's saying it was a Ponzi scheme. He's like, I don't know. But anyway, obviously that all unfolded. Interestingly, I also went back to the original Access database that he had. And sure enough, one of the feeder funds was in there with those, the returns. And I looked at the score and it was interesting that it had been kicked out as a unreasonable outlier or something like that. But Madoff, back to that point, Madoff was when I really started seeing from the institutional investors that we dealt with, the demand for SMAs go up, transparency, liquidity. And that's when, again, I'm importing my own biases on this, but that's when I really started to see kind of the replicator landscape take off just from an interest level. And it was, for better or for worse, it was a very disparate landscape. So, there was the idea, like you said, Lowe kind of kicked off the idea of statistical replication. I think Merrill was the one. We went through that exercise very closely, replicated the results from Lowe's paper, to within like basis points. He kind of gave the whole recipe there. We saw that, I think it was Merrill had launched a note off of that paper to within, basis points. And so the immediate thing we did was just take that model. And what was interesting was Lowe used 5 fixed factors. So he just kind of said ahead of time, we're going to identify a priori, 5 factors, if I remember correctly, that, would have economic justification for, being the underlying drivers of returns for hedge funds. And those were static factors that he used in this kind of rolling window approach against the HFRI W index. So this dependent variable comprised of, all hedge fund strategies. The results were encouraging. Kind of the obvious, and he mentions this in his paper, but the obvious next step would be, all right, there's no reason that, you would want to try and replicate all hedge funds as an asset class. Or if you did, you would want to run the regression on different, more homogeneous dependent variables. And so that's what we did. We already had this database. So we just dropped in our long short equity index into that model. And, the R squareds were higher. And it's worth noting, too, that these are out of sample R squareds because it was a rolling window analysis. That was one of the early criticisms or questions we got was, yeah, but this is in sample. And so, Lowe talks about this. Fung and Shea were 2 guys out of Duke that had done a lot of early work on extending kind of the Fama French model to, 7 and 8 factor models for hedge fund returns. And so, it was, as a quant, I was sitting there saying, all right, this is appealing because it is truly out of sample. We also constrained the universe to ETFs. We did a stepwise process to allow the constituents of ETFs to change from month to month. So we didn't fix 5 factors. We broadened the landscape a little bit, and we started getting really compelling results. Out of sample R squareds of 95% on our long short equity funds, and so that was interesting. I'm going to pivot a little bit though and get back to your comment about kind of the zeitgeist of the area. So meanwhile, so the low paper had kind of kicked off the idea of statistical replication, using a top-down regression approach. Meanwhile, I believe it was Mark Malik over at Conquest, which was a well-known managed futures, had kind of taken a different approach where he talks about I think he published a paper called the beta of managed futures, where he used some kind of momentum. I think he used average true range, or one of the more kind of technical indicators in the managed futures universe. But his point was trend following, or within the managed futures landscape, can be thought of as its own asset class or its own risk premia, and he kind of mechanically replicated a rule set that would harvest or seek to efficiently and effectively harvest that risk premium. And so that was kind of the other side of it, was this statistical approach, this mechanical approach. And then you had the 13F replicators, which was a good idea in theory. But I remember I saw one of the Bloomberg reporters at a conference where I was talking about the idea of hedge fund replication. He came up to me, he's like, "What do you think about the new Guru ETF that's coming out?" And I was, we looked at it hadn't launched yet. So we pulled the filed prospectus and looked at it. And, it was a great idea. But the problem was they were looking at, if I remember correctly, the top 100 hedge funds by AUM, and then just kind of pulling off the long positions from the 13F, because shorts aren't required to be reported, and holding that as a portfolio. And there was some rebalancing. I'm assuming it was a quarterly rebalancing around the 13F cycle. But if you look at the hedge funds that they were replicating, Renaissance was one of the top ones. And so, I told this guy, I was like, I don't have any particular insights into Renaissance, other than, Simons is clearly a genius, but they themselves will tell you, the turnover in their book is like, I don't know, 15 minutes or something. Like a quarterly point in time snapshot of the stocks they hold is going to have zero persistence or forward-looking predictive ability, in terms of the constellation of their portfolio, and then you think about other end of the spectrum, it's like, I think Angelo Gordon, the distressed fund, was one of the top 100 by AUM. Well, the 13Fs is only going to be, kind of stub post IPO type positions that they got stuck with, or it's not going to be an accurate reflection of the risks that they're intelligently underwriting. And so my point was, that was a perfect example of kind of a good idea, but what I would argue is a mediocre or subpar implementation. And so I mentioned that because all of those approaches kind of got lumped in as hedge fund replicators. And so there was a lot of early criticism where people were pointing to these things and saying, hey, 13Fs can't replicate what Seth Klarman's doing. Meanwhile, the statistical approaches can't replicate non-publicly traded asset classes like post-real equities or things like that. And we were kind of waving the flag saying all of that is accurate. However, if you really refine the universe that you're looking at, allow the ETFs that you're using as explanatory variables and ultimately proxies to trade the strategy to vary a little bit, you can get really compelling results. And so that was, just to finish this up, that was when we kind of sat there and decided, all right, this is 2010 at this point, let's start putting firm money in this for the long short equity clone portfolio, as it was called, and then just start tracking this real time.
So you bring up a couple really interesting points. One of the guests I actually just recorded with a couple of weeks ago sat in sort of the manager selection and evaluation space and actually runs a 13F replicating strategy now. And he echoed much of the same sentiments that you had, which was you can't just blindly take 13Fs without really understanding who the fund is and how they operate. Because to your point, it tells you nothing about the shorts that they hold that might be offsetting positions. It tells you nothing about the derivatives that they hold. It might be a far more complex strategy, say, than just a long only. So to him, it wasn't that 13Fs weren't necessarily applicable. It was you had to use them appropriately. And it sounds like that's sort of where you're going, to the point of, yeah, you might be able to look at these common beta characteristics and do replication. But if you have more insight to the funds, it sounds like it allows you to perhaps have that much better evaluation. And it reminds me a little bit of, I think it was Catherine Kaminsky who wrote about the managed futures space, to sort of piggyback on your comment there, where she looked at saying, look, we know there's all these managed futures funds Some trade quickly, some trade slowly. Let's make that a factor. And she mechanically made a fast minus slow factor. She also said there's large funds and small funds, and the large funds have to trade in different contracts because of their size. Let's make that a factor. And obviously the explanatory power went way up when you have these insights into how the industry operates. So I want to roll that into the paper that you wrote in 2011. The title of the paper was Investable Benchmarks in Hedge Fund Liquidity. And you wrote this with Mark Freed and Mark Urell. And it really extended Lowe's work and incorporated some of these ideas. So I was hoping you could, again, sort of expand upon some of the problems you identified in Lowe's original work and maybe some of the solutions you were able to develop based upon your intuition and insights you had from doing all the manager evaluation and selection.
Yep. So the biggest one, and to his credit, Lowe himself kind of identifies this as an area of ongoing work. And it was something, like I said, because of the proprietary database that at that point, had been running for a decade, we had a lot of rich insights into this, was just simply how different hedge fund strategies are very different betas. But then even within each of those strategies, the similarity of managers is much stronger than people realize. So it's kind of like two insights immediately rose to the top, which was, long short equity, and this is very intuitive, to anybody that's been in the hedge fund space, is long short equity hedge funds are very different than stat arb hedge funds. Yes, both of them are market neutral, let's say. Both of them are trading equities, but they're trafficking in different timeframes, they're employing different approaches, they're harvesting different factors. It's a totally different game. And so what we had been doing at the hedge fund, like I said, when we were running our manager due diligence reports, we were benchmarking or running attribution for every manager against their respective benchmark, which was an internal benchmark we created. And like I said, that was, it wasn't just as simple as saying, all right, let's take the classifications. There was a lot of manual reclassifications, quantitative oversight, style drift. And so, we ended up, our long short equity benchmark, looked different enough from kind of the off the shelf eVestment or HFRI benchmarks that there was power there and just kind of cleaning the data. And so that paper really there was kind of three things in that paper. The first one was, we didn't want to go down the path of extending the math and running a lot of fancy different regressions. We had done that internally. It was an interesting exercise, continues to be, I think, in many respects. But what we wanted to do was introduce the idea of, let's keep the math relatively simple and, more importantly, robust. But let's introduce a little more sophistication in the dependent variables. So let's keep the model the same, but let's point it at something that's a little more thoughtfully created. And so we had, I think 10 different internal hedge fund benchmarks that we manually created, updated every month. To give you an idea, we didn't even just look at long short equity hedge funds. We classified it by long short equity North America versus long short equity EM versus sector focused. And so we wanted to make the dependent variables as homogeneous as reasonable. And then the other thing we did was, like as I said, we allowed the risk factors to be different by hedge fund asset class. So the risk factors that we'd be looking at for convertible bond arbitrage would obviously be different from the long short equity funds. We incorporated a little bit of a stepwise process to allow there to be some variability in terms of looking at the different constellation of risk factors. And what we found was, when you use that R dependent variable, when you basically took Lowe's model and pointed it at what we would argue were a little bit more thoughtfully constructed hedge fund indices as opposed to kind of an off the shelf version, that's when we saw the R squareds just go massively up. And like I said, at the top of the list, I think on the first page or second page of that paper, we have an exhibit which maps or shows the out of sample R squareds for all the different hedge fund strategies. And so at the top of the list, not surprisingly, is long short equity North American hedge funds can 95% R squared against a dynamic basket of tradable ETFs, long and short. We constrained the regression to use no leverage. So again, all those problems of kind of just the original kind of hit the button and see what we get type factor attribution reports. We were developing this with the idea that, well, actually at this point we'd been running, this paper came out at the end of 2011. So we'd already been running money in this portfolio for a year. And I'll come back to it, but we actually ended up getting a seed client. A big hospital foundation came in, seeded the strategy with 40 million. And by the time this paper came out, it was upwards of 100 million that we were running in the long short equity North American clone portfolio. And I'll come back because 2011 was an interesting year in the hedge fund space, and it led to another paper that we wrote. But the other thing, which was kind of interesting, and it gets lost a little bit, but ostensibly the point of the paper we were writing in 2011 was it kind of presumed, okay, if you can realistically replicate certain hedge fund strategies, then what is the price of the option that you give the manager if you're willing to accept less liquidity than the underlying? So the premise being that, all right, if I have access to, hypothetically, if I have access to a basket of actual long-short equity managers, which, most institutional investors do, and you have access to a clone portfolio, well, one of them has daily liquidity, one of them doesn't. And let's assume that there's no difference statistically or minimal difference statistically between the two portfolios. I'll even acknowledge that there's potentially a difference, but let's just price that in, or let's account for that. But let's isolate the optionality that you're giving the hedge fund manager by accepting anything less than daily liquidity. And so we employed a bunch of options math to kind of price that out. And, the number, not surprisingly, was high, depending on, kind of where in the matrix where you wanted liquidity, what you were giving up. But like I said, that was kind of secondary to the fact we started getting a lot of interest in the fact that people were saying, wait a second, the options application is kind of interesting, but let's go back to these clone portfolios. Like, how are you doing this? Oh, by the way, you guys are actually managing real money doing this. 2011 was an interesting year because long-short equity funds, depending on the index that you look at, were down, between 6 and 8%. Our clone portfolio, which, for most of that year was over $40 million, I think was down, 20, 25 basis points or something after fees, which was also another big point is, we were charging, I think, 50 basis points or less than 50 basis points for that product. It was running an SMA for this big hospital foundation, full transparency. And interestingly, I don't want to go off on too much of a tangent, but they were huge. I mean, I think they had several $1 billion just in long-short equity funds. And they said they found the most utility. They liked it for a lot of reasons. They could use it for cash. They kind of used it as an ATM machine, so they could access cash, intra-month. They could use it as a placeholder after identifying a manager that they liked but couldn't yet send a subscription into. But they also used it as a real money benchmark to go back to their active guys and say, look, listen, you guys, your tear sheet's saying that you have all this alpha relative to the S&P 500. However, you don't have any alpha or negative alpha relative to this clone portfolio. And they'd say, yeah, but that's not investable. And they'd say, well, no, actually it is. We have $80 million in it. We need to either benchmark your fees relative to this or have a conversation about fees. And that was something that was interesting to me because I just, that hadn't really occurred to me as a use for a big institutional investor, but it was one that they were, it was utility that they were clearly seeing over and above the just the mathematical appeal of the clone portfolio itself.
So talk to me a little bit about 2011. And again, I'm going to take a tangent here. You mentioned that sort of the average long short fund was down 6 to 8%. The clone portfolio was down far less than that. But in theory, a clone portfolio should be sort of capturing the average, right? So it's not the idea that necessarily that a clone portfolio is going to outperform ignoring fees. It should be getting the average. So where did that difference come from? And why should we look at that as a positive thing necessarily? Shouldn't we say, well, you sort of missed the benchmark there?
No, so that is exactly the point. And that is so post 2011, we kind of did a deep dive and said, all right, what happened here? Did we miss the mark? If, clearly we missed the mark, but was it unexpected necessarily? And we had seen evidence of this type of behavior previously. And I'll back up. And so one of the early criticisms we got or questions we got when we were kind of pitching this product was, people said, no, hedge fund managers are way too dynamic for a monthly rebal. So, we, again, as I mentioned, we stuck to the Andrew Lowe approach of, rebalancing monthly, not only because that was kind of the right periodicity, but also that's as frequently as we could get access to the dependent variable. Hedge funds only update monthly. So, we couldn't run it any more frequently if we wanted to. But what we saw was that, when we do those internal attributions for the fund-of-funds, you can infer to what degree these correlation coefficients, turnover over time. And so, not surprisingly, stat arb or market neutral is kind of a good example. Those are, typically higher frequency strategies. And so it ends up, the big issue there, and we can talk about this later, but because their short book was so large, from a top-down statistical approach, it ended up just looking like a lot of cash. And in fact, there were hedge funds. So that was a strategy that we would say, is not suitable, at least not suitable for statistical replication. Maybe you can recreate it from the bottoms up mechanically, but running a linear regression on a group of market neutral hedge funds is basically going to put you in a bunch of cash bond ETFs. Getting back to the long short equity funds, a lot of people were saying, yeah, but hedge funds are way too dynamic. That's what we're paying for them for. And we were pointing to all this data saying, actually they're not. They're value add. And again, at least in the long short equity space, they're very good stock pickers. And collectively, there's really no stock alpha, but there is factor alpha. They are kind of timing the factors in a way that adds value relative to, let's call it S&P 500 over time. They are doing a good job collectively of kind of bundling these factors in a way that makes sense and isn't high turnover. These factor exposures, yes, they're dynamic, they migrate over time, but it's over a period of months and quarters. It's not intra-month. And so post 2011, we were looking at this. And like I said, we had the benefit of running this real time during 2011. So obviously the Greek Euro crisis started to kick off in the back half of the year. Meanwhile, this was still at the fund-of-funds. And so I'm going on these manager due diligence meetings just because it's a phenomenal source of real-time data, particularly during an environment like this. And I'll never forget, we were at still a very big long short equity fund. And we were talking to one of the sector heads, and the guy said, for my entire career, all I've done is pick telecom stocks. He's like, I know every company. I know the space so well. He goes, now all of a sudden, every single day, me and my team are in a conference room on a whiteboard trying to handicap the probability of whether or not Greece is going to default. And he's like, that's just not what we do. And that kind of kicked off, the thought that, wow, these guys, for any number of legitimate reasons, we're dealing with risk factors, not just compensated risk factors, but also, business risk factors. And this was something I credit actually, Mark Hurl, one of the guys who was in business development. He said, don't forget, these guys are running businesses. So you get into the back half of the year, if you're already down, X percent, there's a very good reason to just go to cash. You've got a mortgage to pay, you've got analysts to pay. There's all these we ended up calling these kind of uncompensated risk factors associated with any active manager, but in particular LP funds that investors are essentially funding or exposing themselves to, knowingly or unknowingly. Some investors would say, I don't believe that that's meaningful. Other investors would say, yeah, but that's kind of the price we pay. And so we were observing that real time. Kind of an interesting corollary there is we were getting, so this big hospital foundation, which at that point I think was but certainly our largest client, if not our only client. They had SMAs with a lot of their other long short equity funds. And so these, they were big enough that, even the marquee names would give them separately managed accounts. And what was interesting there was not only, did they have daily liquidity, which they insisted on, but they also had intra-month transparency. And so there's this whole game around, and Fung and Shea talk about this a little bit in some of their early academic literature. And again, we observed it real time, but there's this whole game around, kind of reporting returns intra-month. And there's, if nothing else, just as a price discovery mechanism, the clone portfolio had a lot of value because, these guys would call us, the hospital foundation would call us and say, hey, where's the clone month to date in October, for example? And I'd say, it's down however many basis points. And they'd call back in November during the rebound, if I'm remembering correctly, and they'd say, what's the clone portfolio up? I'd go back and say, all right, we rebalanced from out of these factors into these factors. The clone is up, 300 basis points. And he's like, okay, so, the clone made it all back. And I said, yeah. And, meanwhile, he's like, all right, well, all these managers took risk off and, missed the rebound. And so, that was clearly the factor that the clone, for better or for worse, was insulated against. And that the subject of the 2014 paper argued that factor, that intra-month, when you get out, the factor I'm defining here or attempting to define is when you get outside the time frame, specifically within, call it, an intra-month time frame, where on average the long short equity managers don't add value from rebalancing or managing the net exposure. By insulating yourself from that, kind of sticking to your guns, for lack of a better phrase, in a systematic clone portfolio, you're effectively not paying that tax. And it is a tax over time. And that was the point of the 2014 paper was, to your exact point, we did kind of this debrief in, Q1 of 2012 and said, all right, I'm glad that we outperformed, the benchmarks by 800 basis points, but was it for the right reason? Is there a risk here that we're missing? Could it go against us? And the net effect of this deep dive was, the risk factor that we, by design, don't have exposure to is this kind of what I'm going to call intra-month or higher frequency, risk on, risk off tactical management that the long short equity managers just collectively don't add value. And in fact, actually, it's the inverse. It's even further than that. They collectively detract value. And the thesis, just to wrap it up, kind of the thesis of that 2014 paper, we attempted to quantify it, but the thesis of that 2014 paper was there's reasons for this. There's these business reasons. And, that was one of the benefits I credit the fund-of-funds experience, was just simply having access to these guys. Even if it wasn't me, the partners were all senior guys, they knew the PMs of these funds. One example, and I remember they said, when John Paulson's fund blew up in a good way, when he made that big short subprime trade in 2007, they were kind of laughing. We went in his office to do a manager due diligence thing. And, I remember one of the founders of my fund came out and he's like, yeah, he goes, I remember when that guy was only $200 million in a merger arb fund, which is when they first made their investment. And he's like, he goes, I appreciate he made a lot of money in the short subprime trade. He's like, but that looks a lot different than merger arb, doesn't it? And he's like, you're the quant, you tell me. And I was like, yeah, that's a little bit of a departure. But anyway, to finally wrap this up and not belabor the point, that was an important kind of anecdotes that we were getting as the fund of funds was, we were hearing these guys like at this huge long short equity fund, actively tell us that, they were kind of out over their skis and trying to navigate these kind of, risk on, risk off environment that was typical during 2011.
What I find really, really interesting about the whole discussion of replication is that in many ways it is sort of a crowdsourcing endeavor, right? And there's somewhat of a almost like circular nature of the dependent variable where you're rooting in theory for these active managers to do well, right? Because if you're replicating what they're doing, you would want them on average to do well so that you can sort of track what they're doing. And yet on the other hand, the whole argument for replicators is there's all these sort of perverse and potentially adverse incentives that these managers have. And, oh, look, the replicator is potentially able to avoid that. But if the replicator puts them out of business, well, that actually is one less manager that now the replicator can rely on. So how do you think about that relationship?
No, I mean, that's you hit exactly on it. And this was kind of the, I don't want to say joke, but this was, in 2012, 13, 14, this was kind of, the thing that we kept coming up against both internally and externally was we don't want to put the long short equity funds out of business because, we need them. If anything, we kind of refined that narrative and that clarity that we got from 2011 and said, long short equity funds are our position was that individually long short equity funds, both individually and collectively, add value. We would argue that, there's obviously more idiosyncratic risk at the individual level. Even when you collect a basket of long short equity funds, you're dealing with these kind of uncompensated, what I'm going to call, business risk factors. But it was tricky. I mean, we ended up, the fund of funds business, the guys ended up retiring, the third party marketing firm, the different pieces got sold to different groups. And so this hedge fund replication business ended up being bought by Bannek Global, the ETF shop. And that was one of the things they discussed is they're like, well, are you guys worried about putting the hedge fund business out of business? And the simple answer was the incentives to be a hedge fund manager, at least back then, the incentives to be a hedge fund manager were still great enough. And everybody, there's always going to be a lot of guys that think, their approach is a little different. It's worth taking a swing at. And that was kind of our position was that, they're always going to be there. Collectively, the crowdsourcing, the statistical crowdsourcing approach works on this asset class. But, the other part of it too is we were very clear to investors. The clone portfolio is never going to be up, 30%. It's never, by definition, it's always, it's going to track or should track the indices. So, if you're a smaller endowment or a smaller pension or just a smaller institutional investor and, you're only investing in one or two long short equity funds, it probably, and you have access to them and you don't mind kind of the business risks that you're underwriting, it probably does make sense to just invest directly with managers. You could, one could argue that you could find the guys that are going to do better than the rest of the group. We kind of pivoted our approach to go after the really big guys, like this hospital foundation was kind of the perfect client. They were so big that they needed to benchmark part of their active portfolio in these clone portfolios. And we kind of landed on that as kind of the perfect case study of, how these fit in the ecosystem, in a way that's kind of preserves the homeostasis and isn't too disruptive.
So we spent a lot of time talking about the long short space, specifically the equity long short space, and some success you had there in replication. Were there other areas of the hedge fund world that you found that replication worked really well for? Or maybe more interestingly, the ones where it really didn't seem to work well, in areas you don't think replication can be effective?
Yeah, so I mean, the kind of the first obvious one was like stat arb or market neutral, and that's where I think it was. I remember I got a call. This was so Bannek had bought us out in kind of the middle of 2012, and I think it was like in my first month there, I got a call from a good friend of mine who's the CIO of a big French family office in Manhattan, and he said, "Hey, this group just launched a market neutral replicator ETF." So it's a ETF of ETFs. He goes, I think they're using your same approach. We knew who it was. We'd already done a deep dive. He goes, what do you think about it? And I said, I kind of dug up the research we did on market neutral from that 2011 paper. And I said, the problem there is just, mathematically, it's going to be difficult for any linear approach to kind of disaggregate really the factors on the long side versus the factors on the short side. And so the net result, at least what we found, is it ends up looking a lot like cash or cash plus, kind of levered cash plus type instruments. Maybe some short vol effect in there. And sure enough, at this point, the ETF fact sheet was like 80% TLT, BIL, SHY, like all these cash ETFs. And I told him, I was like, I think that's probably what's happening here. And that was a good example of an approach where we found the top down statistical approach didn't work, wasn't warranted. Launching a product off of that was, I would argue kind of mediocre at best, or certainly suboptimal. And so that part of the issue there from the business side is that contributed to what I would say maybe the stigma against hedge fund replication was there was, even if you weren't a quant, this guy, for example, he's a up and down Graham Dodd value guy, didn't know what R squared one was, but intuitively had an idea. He's like, long short equity, I kind of understand it. He's like, it just feels like something's off. And so, from the business perspective, the rush to get product out there to kind of address these strategies where it just simply, wasn't warranted, didn't really do the quote unquote replication industry any good. And back to your point, so market neutral was one for sure. Market neutral stat arb, where it just the statistical approach anyway didn't really hold any water. And I remember, I think in that paper, that 2011 paper for market neutral, we ended up getting like, 50% R squared. And so, people would always ask, for some reason, that was the one they migrated to. They're like, well, what about this? Can you replicate this? And we turned down money because we just said, you have to treat that as an artifact. First of all, when you kind of, statistically, when you dip down into, as the R squared goes down, kind of the confidence interval around it goes up. I was like, but then, also you look under the hood and it's really just, kind of levered cash or short vol. I was like, you're better off actually, going direct. And so market neutral was one, and that was from a statistical perspective. The other side, which is kind of interesting now, is there were strategies for which statistically we could get good inferences into what they were doing, but the factors weren't necessarily tradable. So credit and distress was kind of the obvious one, and that was another big focus for people. Everybody wanted to hack the access to that space, so to speak. And if you remember back at at this point, 2012ish. I don't know how many smart beta ETFs were out there, but I'd be surprised if it was more than a couple hundred at most. And a lot of them are different iterations of kind of the plain vanilla. But it was growing rapidly, and fixed income ETFs in general were starting to take off. And in fact, we were seeing that real time at Bannek. They had gotten into that space a couple of years prior, but the AUM in those assets was really starting to take off. And I remember in particular, we had a conversation with an institutional investor who was really interested in a credit clone portfolio. Ultimately, we turned it down because we didn't have the confidence that we could transact. We could explain the risk factors there with different kind of bond indices, but we weren't confident in the ability to access those risk factors in a liquid fashion. But I did point to an ETF that was relatively new at that time. That was a Bannek ETF. It was Angel was the ETF, and it was a high income. Fallen Angel is the risk factor, and the idea is that I think it was based off of a Bank of America index, but there was a lot of research in the fixed income space that bonds that were previously investment grade and had been subsequently traded down into the distressed had a more durable kind of high yield risk premium associated with them. It was basically just think of it as a kind of a better way to access the high yield risk premium. We did a deep dive. We loved it. We really tried to make it work within kind of the credit clone portfolio. The problem was there wasn't enough other of those types of ETFs. But we pointed this institutional investor kind of to that and said, listen, this industry obviously is, more of these products are coming to market. And so the number of strategies that will be able to be cloned by hedge funds is only going to increase over time. That's where the smart beta landscape, to borrow a term from Andrew Lowe, has really democratized the migration of alpha into beta, different types of smart beta. And so, yeah, to answer your question, kind of the big ones that didn't work were market neutral stat arb for statistical reasons, but then at that point to distressed and credit for more kind of market access reasons.
So smart beta is a nice pivot, and the evolution of smart beta is a nice pivot into where I wanted to head next, which was a paper that you wrote actually in 2014. And this is something you referenced a little bit earlier in the conversation, sort of danced around a little bit. I want to touch right on it, because there's this common perception in the industry, at least a common phrase, is just sort of wait for the crisis. That's when active managers are really going to shine. And it's this sort of anti-beta movement of, oh, you can go passive, but you're really going to regret that in the crisis. And you wrote a paper called When Does Active Management Add Value? And the conclusions of the paper really pretty much fly in the face of that conventional wisdom that it really wasn't a tremendous amount of value. In fact, perhaps even negative value being added during these crisis environments, particularly among the long-short cohort that you were looking at. Can you talk a little bit about the paper and maybe sort of walk us through the main thrust of it?
Yep. And I'll even set the stage too, because you hit on a key point, which we started to observe right around that time, which was, in 2008, long-short equity funds in particular, but hedge funds in general, clearly didn't live up to their billing. And so investors started saying, wait a second, we're tying up our money, we're paying you 2 and 20, and, you're down 25%, which, is better than the S&P, but, come on, that's not what we signed up for. And, kind of collectively, again, what we saw was, all the hedge fund managers were pointing and saying, yeah, but look at 2000, we did add value. You got to, take a long-term horizon. I think at that point was when Buffett kind of made his bet with another fund of funds about the S&P is going to outperform hedge funds for the next 10 years. And so, then 2011 happened, and that was where institutionally, as you pointed out, at this point, kind of the active to passive migration had started picking up steam. Also, at least from where I was sitting, kind of the idea of these various behavioral theories for, or rather against, active management were starting to take hold. Obviously, Kahneman had won the Nobel Prize years prior, but that was starting to come to the fore in the investing community. And 2011 happened, and like I said, we were running a large amount, I think over $100 million in this clone portfolio, which outperformed by 800 basis points. We did the deep dive immediately afterwards because we asked the exact same questions you did. Is all right, was this expected? Or did something come off the rails? Was this an unintended risk exposure that yes, worked for our favor this time, but could have easily gone against us? And so that was the kind of the setting the table for the 2014 paper, because we were getting a lot of these questions from both hedge fund managers as well as institutional investors. And so all we did in the 2014 paper was take that exact clone portfolio. We didn't want to go down the rabbit hole of trying to improve it. We literally just took the same model we were running, which at that point, had several years of a GIPS compliant track record. We generated the back test going back, I think, to late 90s. And we just plotted, one of the things we found early on was, over a market cycle, the R squared was very high between in this case, the long-short equity clone portfolio and the long-short equity managers. So the alpha was 0 or close to 0. Maybe it was a little bit negative, but the alpha over time varied greatly. And so that was what we wanted to drill into was why was the alpha, negative in 2011? Why was it negative in 2008? And the first thing was to just quantify it. What did it look like? And so that's what we found. The first big insight of the paper was that, the alpha was kind of hovering around 0. We looked at the rolling 12-month alpha of the active managers relative to the clone portfolio. Again, entirely relegated to long-short equity hedge funds. Rolling 12-month alpha was, plus or minus, call it 1%. But then all of a sudden you get 2008, you get 2011, where the active managers just fall out of bed. And, we were very quick to point out that, yes, we're looking at 10 to 15 years of monthly data points. It's only, we're only looking at a sample size of kind of 2 events where we've observed this. But it's the best we've got. It is still robust, and moreover, it also kind of anecdotally fits what we were seeing, which is back to that guy at the multi-billion-dollar long-short equity shop talking about trying to handicap whether or not Greece is going to leave the euro. That kind of frenetic, what we classified in the paper as risk-on, risk-off environment, where the managers are getting outside of specifically the long-short equity managers are getting outside of their comfort zone and trying to manage the net exposure in a time frame that they're just simply not equipped to do. And in the background, all these kind of behavioral reasons. And again, I want to reemphasize the kind of the business risk, and that's something that the institutional sales guys would always talk about is in the back half of the year, if they're down and they're trailing, whatever their benchmark is by a couple hundred basis points, they can come back from that if they just basically, take exposure to zero, sit in cash for the rest of the year and kind of reset the following year. That's not what investors are signing up for. They want kind of dedicated exposure to, various risk premia in a thoughtful fashion. And that's what the clone does while insulating from, the ability to make these kind of intra-month, risk on, risk off decisions. And so that was the point of the 2014 paper. And specifically what we pointed out was, the alpha of the active managers relative to the clone portfolio is roughly zero or slightly negative over time, but it's very negative or very pronounced in environments when the VIX spikes. So, again, 2011 being the perfect example. And so I remember I was on a panel at a conference in Phoenix, I think 2015, where we were talking about hedge fund replication, and the guy next to me was the guy at Credit Suisse who was running their hedge fund replication product, which I think was an ETN at that time. And he and I were, kind of friends in the industry. We traded notes, we grabbed coffee together and things like that. And afterwards there was this guy, and he and I were kind of, preaching the same thing. Guys, look, these clone portfolios work, but you've got to be thoughtful. You've got to do it the right way. There's caveats with this and that. And afterwards, there's this consultant in the audience that was just like, not having any of it. He's like, this, we might as well have been trying to pitch him like, voodoo or something. He was just like, and he was citing individual hedge funds, and it was a smaller consultant, had clearly, had his focus list of 4 long-short equity managers that, always added alpha, and he just, he just wasn't having any of it. But that was I mentioned that because that was kind of a good example, back to your point about at the very beginning, the comment you made about, this would irritate a lot of people in the hedge fund community. And I was like, yes, I can absolutely attest to that, because it was still largely an uphill battle, even in 2014, 2015, to kind of convince people that there was real utility to these clone portfolios. We were very clear that we're not saying this is going to completely remove the need for active managers, but it's at a minimum, there's a lot of utility as a complement.
I think of these clone portfolios a little bit as, and replication and cloning in general, is a little bit of a trivial and entirely non-trivial problem. So I guess what I mean by that is the idea and the math behind it is pretty trivial, and you can get a pretty sophisticated model up and running pretty quickly. In light of our sort of earlier comments we made, last summer when long shorts were struggling, wrote a commentary. I think it was called like Attack of the Clone, because I'm a complete nerd. But I just spent an afternoon hacking together a Kalman filter to track a long short index and got pretty close replication. Now, I had to use complete hindsight. For example, like one of my factors was the NASDAQ, simply because I knew in the late 90s, a ton of long short managers were way overweight tech. And that was my way of sort of hacking that in. Does not mean that would work particularly well out of sample, right? That I was sort of able to get this great replication in sample, not so great out of sample. There are tons of replicating products out there today, available obviously from the banks and available in ETF format, as we mentioned. As someone who has spent a tremendous amount of their career building these types of products, what are some of the ways in which you would evaluate someone else's replicator? What are the questions you would ask? What are the things you would look for? What are sort of the red flags and screens you would think about in determining whether you think a replicator is going to be successful going forward?
That's an excellent question, because it's, obviously, as you mentioned, the proliferation, not only in the smart beta landscape, but in the replicator landscape has just gone exponential since 2012 or 2014. And, the big ones for us is it economically defensible? So, back to that, the CIO at the family office had said, hey, take a look at the market neutral replicator. already, without even digging into the numbers, there's a really good reason that, in this case, at least a statistical replication shouldn't work that well. Same thing for, 13Fs on high turnover, stat arb funds. It's lacking that fundamental premise. And I think that's crucial, not even in the replication landscape, but smart beta, just anything. I think you've written about this. There's kind of a U curve of complexity and utility, or inverted U curve, depending on how you orient the y-axis, where if you think of it as kind of similar to the Laffer curve, where at 0% taxes and 100% taxes, tax revenue is zero. Well, if you swap out tax revenue and taxes for sophisticated complexity, at 0% complexity and maximum complexity, I would argue the utility to the investor is zero or minimal, let's say. And one of the big problems with the rush from active to passive is there has been a tendency, I think, to throw the baby out with the bathwater. And now the problem I'm seeing institutionally is actually not just institutionally but retail as well, is now people are avoiding any kind of sophistication. It's all black box. We were fighting a little bit of this in 2012, 13, 14, 15. And like I said, it didn't help within the replicator subset that there were these kind of mediocre implementations that, didn't do the collective group any justice. But to answer your question directly, the first thing we would look for is just robustness. Did it pass the kind of common sense smell test? Did it pass the statistical test? This was one of the things that the Credit Suisse guy and I would kind of trade notes on all the time, because there were, at least in the academic literature, there's kind of an arms race to get more sophisticated, and a lot of it was warranted, actually. So like Kalman filter is a perfect example. Like, we did some early work, so this adds a lot of utility. Ultimately, it was a product design exercise. We said, the linear regression does close enough. It gets us 95% of the way there. There's fewer moving parts, so it's an easier sell. It's probably a little bit more robust from a lack of assumptions perspective, particularly if we're going to be running $200 million. But that doesn't mean that there's not utility in that additional complexity. You just, you need to quantify it. And that's something, even back to your point about the NASDAQ, I would argue there's an economic justification for having that in a clone portfolio, even if there was no evidence retroactively. So I would look at that and say, all right, that's not data fitting. There's a strong economic justification for having, a high beta sector, particularly because even anecdotally back then, basically everybody in late 90s, everybody except Warren Buffett was overweight tech. And so, even the dyed in the wool value guys were migrating to tech and, figuring out how to classify pets.com as a value stock and things like that. It can be justified. If you had said, I got these great in-sample results on the Swiss franc, that's where it doesn't pass, it may pass the statistical test, but not the common sense test. And so that's, in terms of evaluating replicator products and even just, products and smart beta in general, I would say at the top of my list is just kind of the common sense. Before you even dig into the math and how it's constructed, just the common sense, is there an economic justification for why this should work? And that's what, AQR talks about this, research affiliates, everybody talks about this, but it's easier said than done. And it also highlights, you mentioned the bank platforms, which I think in many ways kind of do good jobs at democratizing, at least for institutional clients, democratizing access to factors in the same way that smart beta ETFs have done it for more retail clients. And the example I give, and again, this is straight out of, I think, an Andrew Lowe paper, where he talks about merger arb. Back in the 70s, there was, only 3 guys doing merger arbitrage. Nobody knew what it was. And there was these huge spreads associated with it. Fast forward to 2009, and there's a merger arb. I think Credit Suisse actually has a merger arb ETF or ETN that mechanically replicates access to that factor. And so there's been a lot of good in that, in what I'm going to call technology in general. And I'm putting the ETN wrapper in that, in terms of democratizing the factor landscape. But the two big issues are it makes complexity a lot easier to inadvertently incorporate unnecessarily and in an uncompensated way. And then the flip side of that is, people have kind of put their fingers up and said, no, anything, even remotely smelling of quant is a black box. It's a data mine. Don't want to touch it. I just want the cheapest ETFs. It's all about cost. And that's, I don't necessarily want to pivot too much, but I would argue, actually, at least from where I sit today, that's the biggest battle we're seeing, is the active to passive pendulum in many ways has swung too far, in that it's kind of oriented people to just seek the low cost provider at the expense of everything, even if it's really thoughtful, complexity the right way, or sophistication, I'll say.
Well, it strikes me that there might be a bit of a balance. So one of the things I was thinking about when we initially started talking about replicators was if I believe that you can give me a really good replicator for long short beta, is there an opportunity for me to then look at the individual factors you're using and change them? For example, if there's a factor in there that looks at value versus growth, is there a way for me to say, you know what, my preferred value factor is enterprise value to EBITDA, not price to book, or this is the way I want to define growth. Or if you're buying a certain type of basket of stocks to represent a sector, this is my preferred weighting methodology, and almost take your cloned beta and then make it cloned smart beta to a certain degree. Is that something you've looked into at all?
Absolutely, 100%. And you hit exactly on kind of the pivot of kind of not only what we're focused on now, but that we started seeing with this first big institutional investor. And it was simply that, back in 2011, there just weren't as many smart beta ETFs. There was maybe 10 or a dozen value ETFs. And now there's several dozen, and there's a lot of different flavors. I think actually Stigma had a good research piece where they evaluated different specifications of value, different weighting schemes, and just simply showed the disparity in any given year depending on how you identified value. And so one of the early conversations we had with this big institutional investor is, we were using a very liquid off-the-shelf value ETF. And we said, listen, there's, this because it's liquid and it's cheap and transparent, we have confidence, especially its size. The last thing we wanted to run into was, trying to become the biggest weight in a smaller value ETF where we had to, go to the APs and try and get creates and things like that. So we opted for liquidity above all else. But we said to them, we could synthetically replicate a more sophisticated or a different specification of value depending on your guys' preference or, our thoughts. And ultimately, we didn't end up going that route. But I actually think it's the highest and best use of that implementation is exactly as you've identified. There's kind of two layers to it. The replication methodology is really a good kind of default asset allocation scheme, let's say. And then depending on, investor preferences, you can manufacture better or smarter exposures than is available on the off-the-shelf, smart beta ETF landscape to kind of have as you said, kind of a smarter beta clone portfolio.
I know that's something you have really thrown yourself fully into, this idea of building your own indices, this indexing as a service. You launched your own firm, IDX Insights, in 2017. Can you expand on the idea a little? Why it fits the market today, what type of clients you think this sort of custom indexing is useful for, and how it works?
Yep. So the genesis is exactly the point that you made. Is we started identifying back then in the early days that there was a lot more that could be done in terms of indexing or creating exposures that weren't available in the ETF landscape. Part of the segue there too is I started to appreciate, having been inside Bannek, which is first and foremost an ETF shop, that got me an access to a lot of other ETF providers and, provided a really good look under the hood of just the business of ETFs in general. And it is difficult, if an institutional or retail client wants a specific tilt on value or a specific take on value, if there's not an ETF that addresses that, then they're out of luck unless they have the ability to kind of do this direct indexing or this indexing as a service. Now, fast forward, technology, again, has really helped kind of disintermediate that. So, and what I mean by that is, so that was kind of the idea for IDX. And it started really as a consulting entity, and then we morphed into a more of a full-blown kind of solution focused on this custom indexing as a service where, we'll go to clients and exactly the same fashion as you said and say, look, here's, don't think of an index as kind of an off-the-shelf take it or leave it option, which is currently what you have with the ETF landscape. We like to think of it as a menu of options. So if you think about value, there's multiple ways you can define value. You can look at one signal, you can look at multiple signals. You can weight them by value, you can weight them by market cap, you can weight them equally. You can increase the number of definitions of value, both in terms of quantity as well as sophistication. You don't necessarily have to go full tilt, Piotrowski F score, but there's somewhere in between. And one of the early engagements I had was with actually a company that was looking, it was an insurance company, and they had an asset management arm where they had a very specific definition, or they had a very specific exposure they wanted. It was kind of a blend of European dividend value focus. And these were entirely bottoms up stock pickers. And so they came to me and with, like a 300 megabyte Excel file with like 36 different rules or screens for value. And they said, we want you to turn this into an index. And I went back and I was like, guys, it doesn't really work like that. Like, first of all, the value we provide isn't just, outsourced quantitative services. It's to help you measure and justify the complexity, help you build the index. Even if you're coming to us with the recipe, so to speak, we're helping you, build it with the highest quality ingredients in the most robust fashion. I want you to be able to cook the same dish with maximum quality all the time under any environment. We must have gone back and forth over months, starting with the simplest version of their rules and then layering, basically creating dozens of indices that would incorporate one more degree of quality, one more degree of complexity, and kind of take it to them and say, there's decreasing returns to complexity, not surprisingly. And to your point about the, kind of the Laffer curve of complexity, the goal isn't to obviously create the best back test. It's all, it's also not to create the most complex or the simplest product. It's to maximize the kind of the Sharpe ratio of the complexity or of the degrees of freedom. And so that's where, to answer your question directly, that's where I think kind of, custom indexing as a service, as we're calling it, is really poised to do well, and is in this kind of subset of investor that's big enough, not necessarily, huge institutions, but, even just bigger, more sophisticated RIAs that have the ability to consume signals directly. They don't necessarily need a 40 Act product to invest. They have the sophistication to understand, why, book to value is different than price earnings. They understand the idea of the trade-off between complexity and degrees of freedom and robustness. And the last point is, again, technology's really made it easy to kind of deliver these custom indices to this group, because they themselves, in many cases, kind of have their own trade desks, or even they don't need prime brokers anymore, like we did in 2010 for the big institutional clients. Even the Charles Schwab's, the IBs, the trading platforms, the custodians have really gotten good at allowing these guys to take in signals, as an example, and incorporate them directly into their model portfolios, run accounts pari passu. And so that's kind of, we had an article a while back where I talked about kind of the technology disintermediating now what I believe to be the ETF landscape. And as this picks up steam, ETFs themselves, they're never going to go away, but they're going to become increasingly obsolete for a certain type of investor who understands that they want something that's not off the shelf and has the ability to take signals and turn it into product.
I really like this idea of Sharpe ratio plotted against degrees of freedom. Talk to me about how you think about quantifying the degrees of freedom of a strategy. Like when you're looking at building, say, a value index or a quality index, what constitutes a degree of freedom to you?
So that's an excellent question. And I guess in many ways, it kind of depends on the strategy. I'll give you two examples, but at the simplest level, there's kind of two ways I think about it. At the simplest level, it's if there's another rule, if you're adding a measure or you're adding a rule, if there's another if then or another screen going into place, we think about that as a degree of freedom. So if somebody wants to move away from just looking at, price to book as the single measure of value and incorporate something else like, price to earnings or price to sales, or probably the inverse, that represents a degree of freedom. Now, I would argue that's a well-spent degree of freedom, because you're effectively buying robustness. And this is something you've talked about and really done a good job illustrating, is, the kind of the fragility of single signals. And actually, a good example is when I was at Bannek, we were evaluating an external index provider that had a long flat commodity index. And so it was, if I remember correctly, it was one look back. It was a moving average crossover strategy where they were looking at the 5-day moving average by, I believe, the 250 moving average applied to the 20 most liquid futures products. Very simple, very robust, the evidence in favor of, so Jan Bannek asked me to take a look at it. And I was like, AQR is written ad nauseum about the utility of momentum, particularly for a volatile asset class like commodities. Mark Malik again. I was like, it makes a lot of sense. However, at a minimum, we'd want to understand, the risk isn't necessarily, yes, you're diversifying across instrument, and yes, you're setting up a rule that's effectively designed to kind of truncate that left tail risk. But how do we know that 5 by 250 is kind of the magic number? And this isn't an optimization exercise, but I want to make sure I didn't inadvertently pick the best iteration of that. And so what I did was go through and evaluated the Sharpe ratio. I created a 3D plot, really pretty heat map, where Sharpe ratio was on the z-axis, and then the fast moving average was on one y-axis, and the slow moving average was on the other. So you had every combination of 0, or call it 5 to 50 days on the quote unquote fast moving average, and I think we looked at 50 to 250 on the slow moving average. And what we plotted was the Sharpe ratio, and there's a million different ways you can look at this. On the z-axis, we kind of swapped out, a bunch of different metrics that we were interested in, but Sharpe ratio is a good example. We plotted this topology, and so it was a really nice heat map. And what you saw, and what I kind of, wrote in for the internal memo is, again, the objective. If we were to run a data mining exercise, we would want to pick the exact tippy top of the global maxima of this topology. We're not in that game. What we do want to do is we want to quantify the degree that there's potentially signal risk of only relying on this one little point on this Cartesian plane of 5-day moving average by 200-day moving average. And it happened to be a little bit lower on the plane. So arguably you could do better just by simply moving to different specifications. But at a minimum, the point I made was you probably want to diversify. You probably want, what we're seeing is that irrespective of what combination you pick, it outperforms simple buy and hold, not just on absolute returns, but, risk adjusted, downside risk, all of that. So why not diversify away from that signal, that single signal? And again, so I think that's a really good illustration, and I always use as an example for clients and prospective clients when we go through this exercise of testing all these different iterations, because it really, even for non-quantitatively oriented people, they kind of instantly get. And I just did this exercise for a bigger RIA, where I actually showed a redacted version of this memo, and they kind of instantly get, okay, I got it. I don't necessarily want to try and pick the global maximum, but I also don't want to have my only exposure be this one signal. And so to answer your question, a little bit more directly, it's those kinds of exercises where we go through. And like I said, with this other client that had a very complex idea about European dividend value stocks, where we anytime there's a new rule or new screen or new something in the recipe, so to speak, we just want to test kind of every iteration that's reasonable to understand what is the benefit from that additional rule, that additional loss of a degree of freedom, and then also what is the risk? Did we inadvertently pick a local maximum, or did we inadvertently pick the one spot that performs well, but if you shift it even a little bit, everything goes off the rails? And so I would say, ironically, or maybe not, but in the kind of custom indexing or indexing as a service area, I would argue that exercise is probably really the value add. It's not that we've got the secret sauce for defining value. It's that our value prop is set up to give the right kind of investor kind of the most comprehensive view of the exposure they're getting, and then ultimately build it and deliver it for them.
So this idea is near and dear to my heart because it's been a business line of mine at Newfounds for the last decade, though I didn't have as good a name as indexing as a service. But it's definitely something I've dealt with. And I wanted to get your thoughts on how you think about dealing with the balance of the client's wants, how the client thinks about building the portfolio, their philosophies in the portfolio, how you manage that with the evidence that you see in a given research strategy and trying to nudge them perhaps towards a more robust implementation. My experience has been, even once you get it live, there's always this sort of tinkerer's dilemma, which is the client keeps coming back and asking you to explore, these minor changes that you might know don't have a big impact, but you need to sort of run the research just for their benefit to educate them. And at the end of the day, what makes it so interesting is you're not just a calculating agent for this index, right? You're not just running it on an ongoing basis. You're not just administrating it. You're helping build it. So how do you really balance that? It's not just what the client wants. It's making sure that you feel like the index is built with integrity as well.
You have hit on exactly the source of, I'm not going to say our biggest dilemma, but it is our biggest kind of time suck's also not the right word, but it's the biggest kind of thrust of this business is managing the expectations, even managing their own risk tolerance. I mean, one thing we've started toying around with in a very simple, you've written about this extensively, and I think it adds a lot of merit to this process, is kind of asking questions at the forefront of the investor, even simple questions like, not the kind of Kahneman, would you, if I give you, two different coin flips and one had a, 78% chance and but even more simple than that, and just saying, for this index, would you, and you've got to be careful here. I'm going to caveat it. You obviously, you don't want to lead them into a data mining exercise, but and it's been helpful for us to help understand how they think about their own objective function, because humans are phenomenal liars to themselves. So, we'll ask the question, 2008 versus 2013 as an example. 2013, the S&P was way up. 2008, the S&P was way down. What would be your preferences for, whatever, a tactical sector product in those years? Because, there's a lot of different implementations, all of which are robust and built with integrity, but they have different risk, they have maybe they even have the same Sharpe ratio, but they have different characteristics from year to year. And like it or not, that matters for a lot of these guys. And so, would you be okay being, flat in 2008, arguably with 30% alpha, but only being up 1% in 2013 when the S&P was ripping? And almost invariably, what we find anyway is, people are, at least the folks we're talking to, they're much more in index hugging mode, I say broad-based index hugging mode than they would like to admit or probably even realize. And so a lot of it, I don't have a good answer for you, but a lot of it is just kind of poking at trying to triangulate in on, to what degree are they susceptible to tinkering, and then, building the product that they say they want, but also really forcing them to come to terms with if that's, really what they want. Because, everybody's like, yeah, I'd love to outperform in 2008. And it's like, all right, well, what if the option was, and again, this is a real exercise. We happen to have, two indices that kind of traffic in the same asset class. They're constructed a little bit differently. And so, one of them is going to be down, call it 15, one of them would have been down and call it 15% in 2008, but it also would have been up more than 20% in 2013 when the S&P was up, 30%. And so that's very different, even if it has the same alpha over a market cycle as the one that was flat in both 08 and 2013. We've found, and like I said, you've written about this a lot. And I think it's a really good way to frame the conversation with clients and hopefully very quickly suss out, what risk do they really want? Because part of, a large risk for them is the tracking error risk, whether or not they admit it. A lot of people say they're absolute return focused, but at the end of the day, relative performance matters a lot more, and they can justify being down less in 2008, a lot easier than they can justify missing out on 2013. But it's tough. I mean, it's the tinker's dilemma, as you said, is huge and candidly way more prevalent than I would have thought.
I want to bring this conversation full circle. We spent the entire beginning of the conversation talking about hedge fund replication and sort of these liquid alternative beta products. We discussed how active managers often add value at the complete wrong time. And now we're sort of shifting into a conversation of becoming systematic active managers. Why is, this idea of indexing as a service necessarily different and not going to fall into the same issues that the clone portfolios were meant to fix in the first place? How do you sort of differentiate these two and say, this is okay where we think the more other active managers might have issues, we still think indexing as a service is not going to have the issues that the clone portfolios were meant to fix?
Yeah, I mean, I think that's an excellent question, because it is, you want to make sure, we don't fall prey to the, do as I say, not as I do kind of syndrome. And I think it boils down to the fact that, we've identified, and I'm not just saying, we locally, but, kind of the industry collectively has identified a lot of issues with active management, with the LP structure in particular, even ETFs. We haven't touched on this, but it's relatively straight, obvious, the massive passive flows into ETFs, are ultimately creating their own uncompensated risk factor, potentially, most obviously in the fixed income landscape, but there's these kind of known uncompensated risk factors, be they business, be they, kind of exogenous non-market risks that are prevalent in the clone strategies, prevalent in any active strategy. And I think all we can do is just kind of be thoughtful about mitigating those risks. And I do think kind of the businesses we're collectively in, there's not a lot of folks doing this, but it is, I think, just a thoughtful next step in terms of saying, okay, here's what previous iterations got wrong. With active managers, with any active kind of discretionary, non-systematic process, you're going to be importing a lot of these behavioral errors, which again, at this point are a lot more obvious and a lot more accepted than they were 10 or certainly 20 years ago. You've got the kind of vehicle issues, certainly with LPs, but also increasingly with ETFs, not only from a, lack of customization standpoint, but also just from, the ETF wrapper becoming its own potential choke point. And so, direct indexing or indexing as a service is just saying, look, we're not trying to do something totally revolutionary, but we are in many ways just trying to kind of replicate what some of the bank platforms have already successfully done for their big institutional clients, and deliver it in a thoughtful, robust fashion to a broader audience. And I think ultimately, I mean, you hit on it. I think it is. I think kind of probably what I would argue is that one of the defining characteristics of this business, indexing as a service, is more of the bespoke coaching, not just saying, all right, we can create anything you want, but our job is to kind of present you the menu of options and help you choose the robust one that fits your risk preferences. And, after having forced you to kind of think through your risk preferences. So I think it is a subtle, but an important distinction.
Last question for you. Totally unrelated to anything we've been asking, but it's the last question of the season for everyone. And the question is this: if you had to liquidate all of your investments today and only invest in one thing for the rest of your life, now that can be an asset class, it can be an investment strategy, it can be really whatever you want, but you can only invest in one thing, what would it be and why?
That's an excellent question. And it's, it's one I've thought about and I've used kind of as an illustrative tool when I, talk to certain folks and say, look, this is kind of a set it and forget it. If I had to, put everything into one thing for the next 100 years, this would be it. And, in many ways, I'm going to copy what Ray Dalio said in one of his early research reports about the idea of, his risk parity. Now setting aside leverage for a second, there's obvious issues with that, but, it's difficult really to improve upon a multi-asset class approach. And I would even say ETFs are fine. If it's long enough horizon, I'd be less concerned about the, kind of the wrapper risks, but it would be, multi-asset class. I would have, some kind of, I wouldn't try and get overly cute with the allocation among asset classes. I would, just probably do it on a very simple risk-weighted basis. Maybe have a momentum filter because again, as we all know, and as you've heard about the math of just simply avoiding large losses, really does compound over time. And if it's truly set it and forget it, you'd want some kind of systematic risk off lever embedded in there. And I don't know that it would be much more complex than that. So, you could kind of think of it as a risk parity approach, unlevered across, any asset class I could reasonably get access to with, a momentum filter and to go to cash, let's say, and true, prolonged risk off environments, 08, early 70s, 2000 type scenarios. I don't know that I would get overly clever. And then of course there's the obligatory 50 basis point allocation to crypto, but that's a whole nother.
There's your upside.
Yeah, exactly.
Well, Ben, this has been a lot of fun. I hope we, in this conversation, have ruffled some feathers. I think your research is really, really fascinating. I definitely recommend anyone listening to go and find the papers, and we'll link to them in the show notes. But if people do want to find more of you, more of your writing, more of your research, get in touch with you, what's the best way for them to find you?
So, our website's probably the best right now, just idxinsights.com. We've got a ton of research up there, and we're pretty proactive about engaging with folks, just even if it's not directly related to us, kind of, doing whatever we can to help. So, this has been phenomenal. By the way, I'm going to say I've been a long time follower of your blog and your writing. So I'm thrilled that we finally got to do this. So thanks for having me.